Welcome to this explainer. I am incredibly excited to have you here today because we're looking at one of the most phenomenal business transformations happening right now in the global markets. We are talking about Samsung Electronics and their truly historic, record-shattering Q2 2026 earnings. Now, if you've been following the AI hardware space, you already know how wild things have been, but Samsung just released data that absolutely demands a closer look.
Okay, let's dive right into this, because this right here is exactly what's catching everyone's eye. If you pull up the over-the-counter ticker for Samsung, you're going to see a jaw-dropping anomaly, a 114% daily gain, catapulting the quote to a $140 share price. I mean, seeing a trillion-dollar mega-cap company flash a 114% daily gain on a ticker, that is easily enough to instantly validate anyone's FOMO. It's completely natural to see that and think, man, I need to get in on this immediately.
But that leads us directly to the central question we're answering today. Is Samsung actually still a buy after this enormous rally? Or are investors arriving to the party way too late? We've got this intense tension right now between absolutely incredible, rock-solid business fundamentals on one hand and a highly aggressive, frankly confusing stock price on the other. So here's our roadmap for today. First, a record-breaking quarter. Second, fueling the AI boom. Third, massive shareholder returns. Fourth, the OTC liquidity trap. And finally, buy, hold, or sell. Starting with Section 1, a record-breaking quarter, let's look at these Q2 2026 results. The sheer scale of these numbers is just staggering. Revenue hit an all-time quarterly high of 171.5 trillion Korean won. That's up 28% quarter over quarter. Operating profit exploded to 89.5 trillion won, which, again, is an all-time record. And earnings per share up 52% to 10,849 won. These aren't just good numbers, right? These are the kind of figures that completely redefine a company's financial trajectory.
And this brilliantly illustrates where that money is actually coming from. Almost all of that mountain of cash is generated by one specific place. The Device Solutions division brought in 127.5 trillion won in revenue and 89.2 trillion won in operating profit. Just think about that for a second. Out of the company's total 89.5 trillion won operating profit, 89.2 came from this single division. So literally almost the entirety of Samsung's massive profit engine right now is being driven directly by their semiconductor and memory business. Which brings us to Section 2. Fueling the AI boom. Let's look at how this demand builds across the global AI supply chain, because it's definitely not about people suddenly buying more smartphones. As AI models get more and more complex, they require massive new data centers. Those data centers require highly advanced compute accelerators. And those accelerators? Well, they are entirely dependent on high-bandwidth memory, or HBM, to function. So the expansion of AI inevitably forces this massive, insatiable demand for Samsung's advanced memory chips. They are perfectly positioned right inside the most critical bottleneck of the whole AI revolution. Just to put a fine point on it, a recent Seeking Alpha report noted that Samsung's memory business is experiencing extraordinary growth simply because AI server demand is absorbing all the advanced memory capacity available on the market. Data centers are literally eating up every single high-performance chip Samsung can manufacture. All right, Section 3, massive shareholder returns. Let's talk about what this means for investors. Are you ready for this number? Reports indicate Samsung is preparing a shareholder return program exceeding 100 trillion won. To put that into perspective, that's roughly 71.75 billion US dollars, backed entirely by the record profits from this AI-driven chip cycle. It's just a colossal scale of capital being directed right back to the owners of the company. And the absolute crucial element of this plan is their mandate to return 50% of free cash flow directly to shareholders. I mean, an investment case becomes undeniably strong when a company combines massive secular earnings growth from an AI boom with a strict mandate to return half of its free cash flow to you. You get the growth and you get the cash. It's a win-win. But here's where we need to stop being blindly bullish. Section 4, the OTC liquidity trap and risks. Let's do a reality check. First, we've got to remember the fundamental nature of semiconductors. They are historically cyclical. Right now, strong demand is raising prices, which causes utilization and margins to spike. That's exactly where we are today. But eventually, memory supply will catch up to that demand. When that happens, prices inevitably face downward pressure and earnings will fall. You have to monitor memory prices every single quarter because this boom, it's not going to last forever in a straight vertical line. But honestly, the much more immediate danger is the stock itself. Look at this comparison. On the fundamental side, you have a 9 out of 10 quality global juggernaut pulling in record revenues. But on the OTC stock reality side, that 114% price spike to $140, that happened on a reported volume of just one single share. You could literally buy a cup of coffee with more liquidity than that.
So I cannot stress this enough. Warning, the $140 OTC quote absolutely must not be treated as a highly liquid primary listing. You should expect massive bid/ask spreads. The displayed price is not automatically a price at which you can easily buy or sell a normal position. You really have to separate the brilliant quality of Samsung's actual business from the extreme dangers of trading a highly illiquid OTC ticker. Always verify the bid, ask, and exact share structure before you ever place a trade.
We also have to stay grounded regarding the macro environment. Geopolitical tensions, especially US, China, and Taiwan trade restrictions, those are ever-present risks for global supply chains. Furthermore, the entire AI stock rally is highly sensitive to broader market catalysts. Take NVIDIA's Q2 earnings on August 26th, for example. That event alone can heavily influence Samsung's trajectory because sentiment tends to move the entire AI chip ecosystem together.
Which brings us to our final part. Section 5, buy, hold, or sell. Let's look at your strategic playbook. When you're deciding to exit, you should only sell when the fundamental thesis actually breaks. Seriously, do not panic sell on a normal 10% market dip. You hit that sell button if memory prices fall sharply, margins collapse, management cuts guidance, AI demand weakens, free cash flow dries up, Samsung loses its competitive edge, or the valuation just becomes completely detached from reality. Until those specific things happen, your thesis remains intact.
Let's systematically break down the exact actions you should take in different environments. If AI demand is strong and valuations are reasonable, or there's a temporary correction during strong earnings, that's a buy. If you already own it and fundamentals are intact, you hold. If there's a huge rally and valuations get stretched, you move to watch. And like we just talked about, if memory prices weaken or guidance collapses, that is a reduce or sell. Now, given the natural volatility of the semiconductor cycle and those glaring OTC liquidity risks we just covered, the absolute smartest way to accumulate a position is by scaling in. This is simply the strategy of buying a stock in fractions over time. You buy your first chunk on a pullback. You buy your second when you see confirmation of support. You buy your third upon earnings confirmation. Doing this mathematically reduces your timing risk and prevents you from getting trapped at a market top. Bringing it all together, here is our final verdict. The rating is a buy on pullback, or a hold if you already own it. The fundamental quality of this business right now is a spectacular 9 out of 10. The AI opportunity is just undeniable. But that OTC liquidity risk is an 8 out of 10. So the fundamentals are absolutely brilliant, but as an investor, you've got to wait for the right entry price and ensure you're executing your trades safely. So I'll leave you with this final thought. Are you going to let OTC ticker FOMO dictate your entry and rush in blindly? Or will you patiently wait for the semiconductor cycle to hand you the perfect risk-adjusted price? The data is all right in front of you, but how you play the strategy is entirely up to you. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll see you next time.